Welcome to the Transparent FX Academy. I'm Nick and I'm a top plotter in TradingView with over 190k reputation points. And in this video, we will try to understand where we have the highest probabilities for a potential move on this pair. Now, how will I be doing that? As usual, first I will be analyzing the pair from a technical perspective, then we will go and see what we have when it comes to the order flow, so the commitment of traders, which is what hedge funds and the non-commercials, so the biggest speculators in the market, are doing. So without wasting any more time, let's jump straight to the charts. Into this video, I want to speak about gold because at the moment we do have quite interesting price action and structure. So let's go straight into it. Now, starting from the monthly time frame, what we can immediately notice is that the market at the moment is testing very strong previous monthly resistance, which was in fact acting as resistance here, again resistance here, creating this red candle that the market broke to the upside with this move to the upside. Now, as you probably already know, when you have resistance and the market breaks it to the upside, that previous resistance usually tends to act as support. So at the moment, what we are actually testing at these levels is previous monthly resistance turn support that in general, we do expect the market to respect, showing a potential rejection to the upside. We can also notice that since we have an impulse and correction, if we want to measure the correction, what we have to do is take our Fibonacci from the low to the high of the impulse. Now, when you're placing the Fibonacci, is usually, and actually it is quite important to place it correctly. The correct way to place it is from the absolute low to the absolute high. Now, in this case, the absolute low is the last time that the market was going to the downside, which was when it was creating this red candle. And after that, we had all this move to the upside from which then this correction started. So the correct way to place our Fibonacci in this case is exactly from here to here. That gives us a 0.786 Fibonacci retracement, which is exactly here, lining up with this previous resistance turn support, indicating how in fact this is a strong support and demand area that we could expect the market to potentially reject to the upside. So looking at the monthly, everything would appear to be quite bullish for gold. If we go down on the weekly time frame, what we can notice, however, is that we have quite different price action. In fact, we can notice how the impulse is actually to the downside, followed by this correction, after which we could expect more continuation lower. It's also important to point out that the market has just created this candle here. And usually when you see a candle like this, in which you have a red body and a very long wick, the next candle is supposed to fill in this wick, therefore indicating that there is the possibility for more bearish continuation, testing in a deeper way this support that we have actually already identified by looking at the monthly time frame. Now, if you have the monthly which is bullish and the weekly which is bearish, this is usually immediately a problem because you have two of the most important directional time frames which are both indicating a different direction. So what we have to do is drop down on the daily time frame to see what we have on it. Now, from a daily perspective, now price action already starts to be quite clear. In fact, here on the daily, we can easily identify how the resistance that we're currently seeing in this market is at the high, and the support that we currently have in this market is at this low. In fact, we can see how we are inside of this range. From here, multiple times the market was rejected to the downside, and there is a good probability that if we will test this level again, we will get rejected once more. And at the same time, here at the lows, we can see how already twice the market has respected this level. So if we will test this zone, there is once again the probability of getting rejected to the upside. So we have monthly time frame, which is bullish, weekly time frame, which is bearish, and daily time frame, which is in a range. Now, how do we approach a situation like this? Before we continue with the technicals, let's first go and see what we have when it comes to the commitment of traders. So the COT data, which is what the non-commercials, so the biggest speculators, are doing in the market. Now, if we check the data for gold, we can see how with the last report, we went from 175K to 154K net positions, with 16.9k shorts added to the last report and 3.7k longs getting closed, making gold quite bearish at the moment. However, we must notice how in general we're still sitting with way more longs than shorts, with 266k longs compared to only 111k shorts. So anytime we could see once again longs getting added and the market continuing with the uptrend. And that is obviously the bigger picture, which we have already seen also by looking at the technicals on the monthly time frame. So how do we approach a situation like this? Well, the highest probability setups come when all the directional timeframes and also the COT data are showing the same direction. Now, in this case, the only way in which that could happen is if the market breaks above the range. In fact, if we remain inside of the range or we break below the range, in both cases, we wouldn't have all timeframes indicating the same direction, because anyway, we know that the monthly is bullish. So only if we get a successful break above the high of the range, after a break on the retest of the high of the range, which in that case would be very strong previous resistance at that point turns support, that is where we would have the highest probabilities for this setup to develop, in which we would have the possibility to complete this impulse correction and impulse pattern to the upside. So if and only if the market manages to successfully break above the resistance on the retest of previous resistance turns support, how we could be approaching this bullish setup. As usual, trading is reactive and not predictive. The monthly, weekly, and daily combined with the COT data, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. Therefore, at that point, what we could be doing is monitoring price action from an intraday perspective during this move to the downside, during this retest, waiting for the market to shift from an intraday bearish market, as we would have, to an intraday bullish market. And if the market would shift from an intraday bearish to a bullish market and provide to us one of our valid entries at that point, we could be looking for a potential rejection higher, with the possibility of completing this impulse correction and impulse pattern to the upside and potentially provide a good asymmetric risk to reward setup. Now, if you don't know what I'm speaking about when I say market environment shift and valid entries, that is all part of the mentorship program, which you can access now completely for free. The link, in fact, is in the description, and I really suggest that you go and check it out. Now, if you enjoyed this video, make sure you smash that like button and comment below. It really does support the creation of more free education analysis for all of you, because obviously it helps with the YouTube algorithm, and I will see you in my next video.